Nobody saw it. $600 billion disappeared in under 4 hours. Then it came back. All of it. In the same day. Markets don't do that. Healthy systems don't erase and resurrect $500 billion before lunch. This is the signature of something breaking beneath the surface. And if you understand what forced liquidation looks like, you already know what comes next. This isn't the first tremor. It's the aftershock. And aftershocks don't come unless the ground already cracked. March 2026. The S&P opened, dropped 1%, and vaporized $600 billion in market cap. Then it reversed, climbed 1.1%, added $650 billion back. The Nasdaq followed the same script, down 1.34%, erasing $536 billion. Then up 1.43%, recovering $540 billion. That's not investors changing their minds. That's not sentiment shifting. That's forced selling. Margin calls. Liquidation algorithms executing without human emotion. When you see two-way violence like that, it means someone, somewhere, had to sell everything they could sell, as fast as they could sell it, just to survive the day. And here's the part that should make your skin crawl. Gold got hit. Silver got crushed. The Nasdaq collapsed. All at the same time. In a normal market, that doesn't happen. When stocks fall, gold rises. It's the fear trade, the safe haven. But when everything falls together, when every asset class bleeds in unison, there's only one explanation. Liquidity crisis. Not a correction. Not a healthy pullback. A scramble for cash. The dollar rises, and it acts like a wrecking ball, smashing everything in its path because leverage is unwinding and no one cares about fundamentals anymore. They care about survival. Same pattern. Same sequence. Same outcome. Let me take you back. Rome. 3rd century. The denarius was 95% silver when Augustus ruled. By the time Diocletian took power, it was less than 5%. They debased the currency to pay for wars, for bread, for circuses, for the bureaucracy that kept the empire from eating itself. And it worked for a while. Until it didn't. Inflation exploded. The legions refused to fight unless paid in gold. Trade collapsed. The empire fragmented. The currency died first. The empire followed. Verified. Fast forward. The Dutch. 17th century. The richest empire on earth. The guilder was the reserve currency. Amsterdam was the center of global finance. Then came the wars. The Anglo-Dutch Wars. The cost of defending trade routes. The debt piled up. They kept borrowing, kept spending, kept believing their currency would hold because it always had. Until the British and the French outspent them, outnavied them, and the guilder lost its status. The wealth transfer happened in a single generation. The merchants who saw it coming moved their gold to London. The ones who didn't lost everything. Check. Now Britain. 1914. The pound sterling was the global reserve. The sun never set on the British Empire. Then 2 world wars. Debt exploded. They spent everything to stay in the fight. And when the smoke cleared, they were broke. The US held the gold. Bretton Woods made the dollar king. Britain kept the pound, but it didn't matter. Reserve status was gone. And with it, the ability to print wealth out of thin air. The empire didn't collapse overnight. It bled out over decades. Soft default. Austerity. Decline. The currency broke first. The empire became a memory. Verified. 3 empires. 3 collapses. Same pattern. Debase the currency. Fight the wars. Accumulate the debt. Lose the reserve status. Transfer the wealth. The cycle doesn't change. The names do. And if you think the United States is immune because we have the military, because we have the technology, because we've always been the exception, you're not reading the pattern. You're reading the propaganda. Let me show you where we are. U.S. national debt just crossed $36 trillion. That's not a headline. That's a mathematical certainty of collapse. We add $1 trillion in new debt every 100 days now. The interest on that debt is over $1 trillion per year. We are not paying down the debt. We are borrowing to pay the interest on the borrowing. That is the definition of a death spiral. And it doesn't slow down. It accelerates. Now look at what happened last week. Banks tapped the Federal Reserve's repo window for $11 billion. $8 billion in treasuries. $3 billion in mortgage-backed securities. That's the emergency liquidity facility. The one that sits silent during calm markets. The one that only gets used when banks can't find cash anywhere else. And this is the first time it's been touched since January 2nd, when $22.8 billion was drawn down during the historic silver squeeze. Something is breaking, not in the headlines. Beneath them, the FOMC minutes drop tomorrow. Thursday and Friday bring high-impact economic data. If you've studied how these events get used, you know that big players don't wait for the data. They use the volatility around the data as cover. They position before the announcement. They liquidate during the chaos. And retail investors, the ones watching CNBC, the ones waiting for confirmation, they're the ones holding the bag when the move already happened. Here's what the options market is telling you. Silver's CVOL, the volatility index, is at 115. The normal range is between 15 and 40. Anything above 100 is extreme. Rare. And here's the part that should terrify you. It's now 10 points higher than when silver hit $120 3 weeks ago. The options market is pricing in more explosive movement right now, at $73, than it did at the all-time high. That's not speculation. That's math. Traders are paying massive premiums for protection because they expect violence. They expect turbulence. They expect something to break. And someone with serious capital is betting on it. A large investor has been buying December 2026 gold call option spreads. Strikes at $15,000 to $20,000. Gold is under $5,000 right now. For this trade to pay off, gold would have to triple. And this buyer didn't start when gold was cheap. They started accumulating after gold hit $5,600 in late January. Even after it fell below $5,000, they kept buying. Open interest is now around 11,000 contracts. That's not a gamble. That's conviction. Someone knows something. Now layer in what's happening in the physical market. Silver in the West, spot price $73. Futures $73. Silver in Shanghai, spot price $86. Futures $88. That's a $13 premium. The East is paying more for physical metal than the West, even while Western paper contracts are getting crushed. That divergence doesn't happen in a functioning market. That happens when the paper market and the physical market are decoupling. When the price on the screen stops reflecting the price of the actual metal. Let me tell you what forced liquidation looks like, because most people have never seen it. A hedge fund is long everything. Stocks, commodities, crypto. They're using leverage, borrowed money, to amplify returns. Then something breaks. Tech stocks fall. They're down 5%. Suddenly, they get a margin call. The broker says, you need to put up more cash, or we're closing your positions. But they don't have cash. Everything is invested. So they sell whatever is most liquid. They sell gold. They sell silver. Not because the thesis changed. Not because the fundamentals broke. Because they have no choice. And when that selling hits the market, it doesn't matter that there's a supply deficit. It doesn't matter that industrial demand is at record highs. The price falls because forced sellers don't negotiate. They take the bid. Charles Kindleberger wrote the book on this. Manias, panics, and crashes. Financial crises follow a pattern. Euphoria, expansion, peak confidence, profit-taking by insiders who see the top coming. Then panic. The leverage unwinds. Forced sellers dominate. And fundamentals become irrelevant because no one is thinking about value. They're thinking about survival. We are in the panic phase. You can see it in the intraday swings. You can see it in the repo window. You can see it in the dollar ripping higher while everything else bleeds. And here's the part that most people miss. Metals sell off before equities. Every single time. Before the 2008 financial crisis, gold and silver dropped hard in the months leading up to the collapse. Not because the thesis was wrong. Because liquidity dried up and everything got sold. Then, after the forced selling exhausted, after the weak hands were shaken out, the metals exploded. Gold went from $700 to $1,900. Silver went from $8 to $50. The ones who understood the pattern didn't panic. They accumulated. You want the bearish case? Here it is. The dollar keeps ripping higher. Global liquidity tightens. The Fed could hike rates again to defend the currency. The equity market could collapse another 20%, forcing more liquidation in metals. The technical support at $72.60 to $70 in silver could break, sending it down to $67 or lower. The CVOL spike could resolve without the explosive move ever materializing. China could flood the market with metal to defend their currency. All of that is possible. But here's what doesn't change. The structural supply deficit in silver is entering year 5. 200 million ounces of annual shortfall. That's not a forecast. That's geology. That's mining output versus industrial consumption. Solar panels, AI infrastructure, electronics, 5G, defense systems. All of them require silver. And production isn't keeping up. You can manipulate the paper price. You can't manipulate the physical deficit. And here's the other thing. Only 0.03% of global wealth is allocated to silver right now. In 2011, during the last metals bull run, it was 0.06%. That's half the allocation. If we just return to 2011 levels, not exceed them, just return, the price has to double from here. And if we go beyond that, if silver starts being seen as monetary metal again, as central banks diversify away from dollars and into hard assets, the upside isn't 2x. It's 5x. It's 10x. Now let me show you what manipulation looks like when it's not theory. September 2020. JP Morgan paid $920 million in fines. Case number 1:19, CR 438. Precious metals spoofing and market manipulation. Two of their traders, Michael Nowak and Greg Smith, were sent to federal prison in 2023. Not fined, not suspended. Prison. For spoofing the gold and silver markets. Placing fake orders to move the price, then canceling them before execution. This isn't conspiracy. This is settled case law. Criminal convictions. And the same institution that paid those fines, that sent those traders to prison, still holds massive concentrated short positions in the CFTC data. You think that behavior stopped because they got caught? Or do you think it went underground? Do you think the fines were big enough to matter to a bank that makes tens of billions in profit every year? The manipulation continues because the incentive structure hasn't changed. The CFTC knows. The exchanges know. The banks know. And retail investors, the ones buying paper silver ETFs, the ones trusting the price on the screen, they're the ones getting fleeced. Here's what the technical structure is showing. Silver daily chart. Mark a horizontal line at the low of Wednesday, December 31st, 2025. Now look at the rate on February 6th, 2026. Price dropped, tested that December low, and then the body of the candle closed above it. That's a swing failure pattern. Bullish. It means the sellers tried to break support and couldn't. On the lower time frames, you can see an inverse head and shoulders forming. No displacement yet. No violent move confirming direction, but the structure is there. Right now, support is between $72.60 and $70. We may go lower. But if price wants to go higher, I don't want to see body closes below that level. A close below $72.60 signals weakness. Could mean a move down to $67 or lower, back to that February 6th wick. But if we hold here, if we get displacement, a violent move with volume confirming conviction, we could see $75, then $77. This isn't a buy signal. This is tape reading. This is pattern recognition. And here's what most traders don't understand. High volatility doesn't predict direction. It predicts chaos. The CVOL at 115 means the options market expects massive movement within 30 days. Up or down, it doesn't matter. Turbulence is coming. And turbulence creates opportunity if you know how to read it. Now step back and look at the macro picture. The dollar is ripping higher. The VIX, the fear index, is rising. Treasury yields are falling. That combination, those three things happening at the same time, is one of the clearest stress signals you can see on a chart. When the dollar rises, global liquidity tightens. When the VIX rises, institutions are hedging, pricing in risk. When yields fall, money is rotating into safety, into bonds, because the bond market is quietly pricing in a slowdown. This exact combination has preceded every major equity drawdown, every commodity sell-off, every credit crisis in modern history. Not opinion, pattern recognition. Hyman Minsky wrote about this. Financial instability doesn't grow during chaos. It grows during stability. Leverage builds beneath the surface. Everyone thinks it's fine because prices are stable. Then something breaks. A margin call. A bank tapping the repo window. A forced seller hitting the market. And suddenly, the stability flips to crisis. Not gradually. Instantly. The deleveraging happens first. The dislocations, the artificial price drops divorced from fundamentals, those come during the panic. The opportunity comes after, when the forced sellers are exhausted, when only the conviction holders remain. When fundamentals reassert, we are not at the cliff. We have already walked off it. The question is whether you see it before you hit the ground. The smart money is leaving equities. They're leaving bonds. They're moving into hard assets. Gold, silver, land, things that can't be printed, things that survive currency collapse, things that have survived every empire collapse in history. You want to know what this looks like for a normal person? ATMs stop working. Not because the power's out, because the banks don't have cash. Prices explode overnight. Not 10%, not 20%. Double, triple. A loaf of bread that costs $3 now costs $10. Your paycheck, if it still comes, buys half what it did last month. The grocery store shelves empty because supply chains break when currency loses trust. Gas stations shut down because truckers won't deliver for worthless paper. This isn't science fiction. This is what happened in Weimar Germany, in Zimbabwe, in Venezuela, in every hyperinflation in history. The currency dies, the system collapses, and the people who didn't see it coming lose everything. But here's the other side. Every collapse is a wealth transfer. The Romans who held gold survived the fall of Rome. The Dutch merchants who moved their wealth to London survived the guilder collapse. The British aristocrats who owned land survived the pound's decline. Wealth doesn't disappear. It moves. From those who trust the system to those who understand the pattern. Silver is at $73, down from $120. Sentiment is screaming that it's over, that the bull market is finished, that you missed it. And that's exactly what sentiment said in 2008 before gold went from $700 to $1,900. That's what sentiment said in 2020 before silver went from $12 to $30. Fear creates bottoms. Euphoria creates tops. Right now, we're in fear. And fear is where conviction holders accumulate. The options market is pricing extreme volatility in the next 30 days. The banking system is showing stress through the repo window. Technical support is identified. Sentiment has been washed out completely. 3 days of high-impact economic catalysts start tomorrow. The question isn't whether volatility arrives. CVUL already told you it's coming. The question is whether you understand what deleveraging creates. Artificial dislocations. Price drops that have nothing to do with supply and demand. And those dislocations correct violently when the selling exhausts. You can't unsee this. Once you understand the pattern, you see it everywhere. The debt, the debasement, the loss of reserve status. It's not coming. It's here. The $600 billion that vanished and came back in the same day wasn't a glitch. It was a warning. Something broke. And when things break in the financial system, they don't get fixed. They get papered over. They get bailed out. They get printed away. Until they can't be. Until the currency itself loses trust. Until the system resets. This is not might happen. This will happen. Mathematical certainty. And the only question that matters is whether you're positioned for it, or whether you're still holding paper, trusting the system, waiting for someone on television to tell you it's time to move. By the time they tell you, it's too late. The smart money already left. The transfer already happened. And you're left wondering how you missed it. This is financial warfare education. Not investment advice. Not a guarantee. But pattern recognition. History doesn't repeat, but it rhymes. And right now, it's rhyming so loud you can hear it if you're listening. Subscribe if you want more of this. If you want to understand what's coming before it arrives. If you want to see the pattern while there's still time to act. Because the next 30 days are going to be violent. And violence creates opportunity for those who understand what they're watching.